So good day, everyone. I welcome all us to another class. So I hope so far we've been enjoying the class and we've been gaining one or two things. I believe so. So today we are going to be looking into principles and method of valuation. Principles and method of valuation. As, as much as you can. I really do not, especially for these aspects. This is the most sensitive part, and I just don't want you to, listen at the same time as you are listening. Jot, please jot some keynotes because there's this saying that says the faintest pen is better than the best brain. So that even after this class, you can have something to hold on to look through, even without watching the video. And well, the video is still on this platform for you to play over and over again if you didn't get the first time. So if it's another avenue for you to listen and listen and listen more and more till you are satisfied that, oh, I think I understand. So there is every tendency for you not to understand at first. So subsequent hearing then gives more understanding. And I always say, the more you hear, if you have any question bothering you or you are not clear about anything, don't hesitate to drop your questions, and then I'm going to respond to them accordingly. So let's move into this class. So as I said earlier, that we are going to be considering the principles and methods of valuation. So for the purpose of this class, we are going to be looking at the comprehensive overview of the meaning of valuation, the methods, and its application. Its application. So, so by way of introduction, let's quickly go into what valuation is. So the name valuation, as it implies, we can see that it's gotten from the word value. So I know we might have gotten the last notes where we discussed them extensively on the relationship between cost, value, and the price. So along the line, during the course of this lecture, we are still going to, just mention it and not really draw, because I understand that there is a lecture on that already. I really do not want to bore you with on too much explanation. So as the word implies, valuation is an estate management term that is used is an aspect of our profession. Let me put it that way. It's an aspect of our profession that requires uh, specialized training, that requires specialized skills. So we know that compared to agency, we know that well, there might not really be any necessary skills like that. In as much you can convince a buyer in the aspect of agency to, so we can say that anybody can buy and sell. So we can say that even in property management, somebody by the roadside can wake up and say, okay, I'm managing properties. But it's not so in valuation, because it requires some training, it required some skills. So by way of definition, I would say that valuation is basically an art and science. It is an art. Please, let's note that word. It is an art and science. It is an art and science during the course of the lecture also, we'll still expand on that aspect. I want you to see valuation as what, as in two arms, the art aspect and the science aspect. So we can say that by way of definition that valuation is the process of determining the present worth or a fair market value of an asset or a property or a business or an investment, considering its potential income, utility, location, condition, and market value at a particular time. At a particular time. And I know it forms some basis. Like if you want to carry out evaluation now, you don't just sleep and wake up that, okay, I want to carry out evaluation. There must be a reason why you are carrying this valuation. There must be a reason. Why do we even need valuation? Why do we need to carry out valuation? Why do we need to value a property? Why do we want to know the worth of our property or properties, as the case is? It could be more than one. Why do we want to go through, oh, I want to do this? Or why are people not even doing it? Probably because there is no knowledge of what valuation is. Probably because public are not always enlightened on what valuation is and how it is used and how it is used. So I said earlier that we are going to be looking at the arms of valuation, which I said it could be um, art and what and science. So if we are saying valuation is let me take the science aspect first. So if we are saying valuation is a science, we are saying that it has some established economic and financial principles. Because as time goes on, I'm going to be opening you up to some mathematical tools. I'm going to be opening you up to some formulas. I'm going to be opening you up to some principles. So you using some mathematical tools, analytical tools, some economic factors, some financial principles, then in a way you can classify that as the science aspect of valuation process. Valuation process. Talking about the quantitative analysis, the data analysis, the market survey, your capitalization, your depreciation, your discounting techniques. So basically, when you're talking about, and again, the measurement aspects, which has to do with the length and breadth for a regular shape of a property, and in case of irregular also, you should be able to cut it into regular shapes. Probably you have an irregular shape, and at the end of the day, after cutting, you were able to bring out a triangle from a shape. You were able to bring out a rectangle from an irregular shape. You were able to bring out a trapezium from an irregular shape. So in a way, you doing all these processes is called what? Is the science aspect of valuation. It's the science aspect of valuation. Then the art aspect at the same time requires, because we know that valuation in a way requires some judgmental skills, some professional judgmental interpretation, including your experiences also. So when you are trying to make some, because we know that markets are being influenced by human behavior, human emotions, human perceptions. So you trying to interpret this with the data you have, considering the method to come out with your own results or to come out with your own value, we can say that, okay, this aspect is the heart of valuation. This aspect is the what? Is the heart of valuation. So when you are asked to carry out evaluation, just know that in a way. And I would like to say something about the art part because after your calculation might have been done, your market survey, you've gotten everything, and you are trying to come up with your value. Most of the time in valuation, what you come up with is an opinion of value. So the opinion of the valuer is being stated. That is why most of the time you see variations in opinion of value on even the same properties because our judgmental skills are different. Our experiences also, our exposures, our interpretations to things also forms our what? Part of our judgment. Also form part of our judgment. Fine, there are variations, but it shouldn't be wide. But plus or minus, it should be within the same boundary. So we can say that the heart aspect is a factor that contributes to our judgmental skills, that contribute to our interpretation, that contribute to um the value that we even arrived with at the end of the day. The value we arrived with at the end of the day. So this I can say that this is a balance between the analytical rigor and the experimental understanding. Understanding is what makes up what valuation, is what makes valuation a profession that requires both what your technical competence and also that informs your judgment, that informs your judgment. Please let's take note of this area, and they will be looking straight into the objectives of valuation. I said it earlier during my introduction that why are we carrying out valuation? Why do we even need to value our properties? Why are we doing all that? So we must be able to get acquainted with the reason why we even need valuation in the first place. So the first one I would like to discuss here is for your sales transactions, for your purchase transactions, definitely you'll be needing what? You'll be needing what? A valuation exercise. If you want to sell any property, if you want to buy any property, you need a what? To carry out a valuation exercise on such a property. And why are you doing this? You are doing this in order to be informed about the worth of that property. Oh, the amount they are selling it, is it truly the selling price in the market? That is the work of a valuer, to help you to what? To help you to confirm. And then in terms of purchase, you want to purchase a property. You need to carry out a valuation exercise because valuation exercise in a way will form your own decision. So we can as well say that valuation exercise or valuation report is a can be is a decision making tool that will guide you on the type of decision you are going to be taking. Oh, am I selling rightly? Is it something I should sell now? Is it something I should hold on? What are those parameters that surround my selling processes? Oh, when I'm buying, am I buying rightly? Am I not being cheated? Am I on the right course? Is it good to buy now? Or should I hold on a little bit? Evaluation should be able to what? Tell you all that. Tell you all that. Because in every transaction, it's the valuation you are getting for your sales, for your purchases is for just for you to determine the fair price for valuation of any transaction Then the second one is your mortgage or loan. So when you are trying to assess a a credit loan from the bank, it is expected that you carry out a valuation exercise, because you can't secure a loan from bank, and when you have a collateral that you want to, probably a property rather, sorry, that you want to use as a collateral, it is expected that such a property should be what should be valued, because it is the value of that property that would determine if you are liable for such facilities at the bank. So the bank will assess your property if it is sufficient enough for you to what to tender as a what as a collateral, or do you need to add more in order for you to be able to what to qualify for this mortgage loan. For this mortgage loan. So another purpose why we carry out valuation is also for what, if you want to use your property as a collateral to secure loan in the bank. Then another one is taxation. We know that taxation is very broad. Taxation is very broad, and we don't just tax goods and services. There are taxes on properties also. For example, our land use charge, our tenement rates, and the likes. So for you to know the amount you are going to be paid, it is expected that your property is valued in order for them to be able to know the amounts they are going to be charging on, or the rates they are going to be making use of your capital value, your gross value, your rental value. How do we get that? We get that during the process of what? During the process of valuation exercise. We get that during the process of valuation exercise. In the case of our property taxes, our capital gain tax, our wealth tax, and so on and so on. Then another one is the insurance. We know that we do insurance for to secure your properties. We do insurance to secure your properties, and in case of any damage, in case of any fire outbreak, or death, or accident, or natural occurrences, there is always a provision, especially when you pay your premium as at when due, and also when such a property is being insured, which shows that, oh, this property has a cover. So in a way, this is what you need to carry out, what valuation on such property or on such assets, in order for you to know, oh, how much are we looking at? What is the worth of the property you are making covered for? So as to know, oh, what to do. And in insurance, what is expected of us is to get two values, which could be reinstatement or indemnity. Are we giving you new for new, or are we giving you old for new? Do you understand? So basically, we need to carry out what valuation exercise for also what for insurance. Then another one is the compulsory acquisition. I think I mentioned this, that should be last 2 weeks in our physical class. So this has to do with compensation. In a situation where the government acquire a certain part, a certain part, and it is being used for the public interest. For example, if the government needed a construction of roads, and you know that no way, no how, somebody will lay hold to where the land that the construction is going to be taking place. So when that is in process, it is expected that everyone that has land at the coordinate of where the road is going to be constructed, or where the railway is going to be constructed, or any projects, BRT stand, whatever the case is, should be duly compensated. And how do you get your due compensation? You need to carry out your valuation exercise, so that they can know the worth of your property, so that they can know the amount they are going to compensate you with. So that is why we carry out valuation exercise for what? For compulsory acquisition. acquisition. Then another one is for investment decision. Investment decision. I know this is very germane, this is very paramount because by the time you carry out a valuation exercise for your investment decision, in a way, it will give you an information on the kind of properties to buy. Oh, if I buy a block of flats, or probably, oh, I want to buy a block of flats, I want to buy a shopping mall, and at the end of the day, you are looking for the one that is more profitable. Valuation should be able to what give you an overview of what you should expect. So it forms your decision. Oh, this one, we have this also value. If the rent is going for this, you can recoup your money in the space of 5 years. Oh, if you go for a shopping mall, it might take a time for you to recoup your capital. It's those it's valuation, those valuation exercise, they although fine, they forms your judgment, they help you to know the kind of investment decision to make, investment decisions to make. And the last one I'll be talking about is mergers and amalgamation. So this has to do with two companies or more companies that are coming together, that are pulling resources together. And I must also tell us that we don't only do valuation for just land, what we can see, the tangible ones. We also do valuation for intangible, your patents, your goodwill, your franchise. We do valuation for that also, just to know, oh, what are you bringing from your company? What am I bringing from my home company? Oh, from where we are now, this is the worth of our property. Oh, this is the worth of our property. Oh, let's put resources together. And during the course of you pulling resources together, it gives you an information that, oh, you are coming with the 40%, another person is coming with the 20%. So in a way, it gives you a broader view of how the sharing ratio should be. At the end of the day, where you have profit, it shows that the person that is coming in with worth of property of 40%, you should be taking 40% ratio of the profits, and the person coming with 60% should be entitled to what? 60% of the profits. So that is how valuation work for all these purposes that are highlighted. So the various this leads us to the various methods of valuation that we have. We have a number of them. We have a number of them, and we have different approaches. And this is also dependent on the kind of property it is, and also the purpose. So these two forms the kind of approach, or the kind of method you are going to be adopting. So we can say that the method of valuation is a dependent variable, on the type of asset you have and the purpose. So the asset and the purpose are the independent variables. So the first one we are going to be considering is the cost approach. So for the cost approach, when do we use this kind of approach? We use cost method approach and for new buildings. For new buildings, we use it for public utilities. We also use it for what? Special purpose properties. And basically, I would like to, for as a way of emphasis, I would like to also say that especially for properties that seldomly or hardly changes hand, so we can say cost approach is what is suitable, and then when by the time we go into the calculation aspect very well, you are going to be having formulas also, but just on the surface, we can say that for you to arrive at your value for cost of approach, then you can be talking about your replacement cost, which is the cost of construction minus depreciation plus land value. So let me come again. You get the value, you estimate the cost of construction of that property, then you deduct your depreciation, and then you add your what? Your land value. And examples of properties you can use cost method for, I said it earlier, for new buildings, for public facilities, for specialized purpose properties such as schools, hospitals, hospitals, your factories, that you know that they are public utilities, public schools, public hospitals. Then the second approach is the market approach. So we can also say that our market approach is our also comparison method. We can also call it comparison method. And I would like to say that this market approach is used for virtually all to just run a check on all the methods, all the other methods of valuation. So we can say that this approach is suitable when we have what a similar recently sold property in the market, in that neighborhood, in that neighborhood. There are some adjustments that are made on we have, because we have differences in location, in size, in condition, in amenities, in finishes, and the likes, and the likes. So what you are looking for under market approach or comparison method is what you are going to identify a comparable asset that is recently sold in that neighborhood. You making some adjustments because we know there can be variation in the sizes, the condition, the finishes, which will now form your own judgment to arrive at the what as the market value. To arrive at what at the market value. And most of the time, when do we use this? We use this for residential properties. We use this for residential properties that are recently sold. We use it for land valuation. We use it for real estate market appraisal. So as I said earlier, virtually for all methods, we use what our we can also say sales comparison. And when you talk about when you are trying to make a sale and you are trying to buy, so in a way you should know that you are going to be using what market approach. You know, I said the type of asset will also the type of asset and the purpose will also determine the kind of approach you are going to be using. So when somebody is selling and when somebody is buying, you should know that the best approach is what is market approach. Market approach. Then another one is the income approach. Income approach. So another name for income approach is we can say capitalization method or in a way investment method. But I'll still try to explain the differences between the income approach and the investment method because I know it can be confusing sometimes. So properties that were under this income approach, the value is based on the net income the asset is generating. The net income the asset is generating because it is assumed that a rational investor will pay price that gives a satisfactory return. A satisfactory return. So the income approach is always used for properties that you are generating income from. Property that you are generating income from. So basically, our net annual income is being capitalized. Is being capitalized. So in this aspect, then we can be talking of our yield. We are applying our yield to the net annual income. We are capitalizing on this. And examples of properties under that we can use the income approach for is we have our commercial buildings, we have rental properties, and valuation for businesses. Valuation for businesses, because now we are not talking of income. Valuation for businesses. Then another method is the profit method. Is the profit method. So the profit method is so this is used when the properties value depend directly on the profit the property is generating. Then I always say that basically it is used for businesses of properties that has an evidence of bookkeeping record, their transaction record, their details. Then you can be talking of the profit method, because basically what you need to capitalize on is the profit they are making, is the profits, is the profit. So an example of this is, then we can be talking about our hotel, our cinemas, our filling station, a functional one, our restaurant, our supermarket, our pharmacies. So basically, what we capitalize on is what? We capitalize on our net profits. We capitalize on them, on our net profits. Anywhere we see return, then we should know that we are using what? Profit method. Profit method. Then another one we'll be considering also is we call it residual method. Residual method or development method. So basically, this is, as the word implies, this is used for for undeveloped land. For example, your beer land, or properties that need that for a redevelopment, for a redevelopment properties, you need this also. For redevelopment properties, you need this also. Then you can be talking of, okay, because it is expected that as time goes on, there's still going to be what? Profit after what? After completion. Profit after completion. Then we have the investment method. We have the investment method, as I said earlier, that relating it with the income. So it is expected that any property that is generating rental income, we consider it that, okay, this is what we are going to be using, was investment method. We are going to be using the investment method. Please take note, rental what? Rental income. Then the second to the last is the analytical method. Analytical method. So basically, this is used mainly for businesses or for company valuation based on their what? On their balance sheet items. So we are going to be considering their net assets, putting into consideration their total assets and their total liability. Total assets and their total liability. Then the last one is the rule of thumb. Rule of thumb, or we can say the experience method. So basically, this just is based on the industry standard or the empirical ratio. Empirical ratio. So this is basically used for just quick estimates. This is not a formal method of valuation, but quick estimate, like roughly, what do you think? In a situation by somebody just call you and say, what do you think this can be, even without you carrying out anything, but based on your experience, you were able to say, oh, I think for this also property in this area, you should go for, even without you carrying out your tools, your science, and the likes. So these are the various methods of valuation that we have. We have.